We're here in Monte Carlo for the Rendezvous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Andy Marcell, Chief Executive of Aon Reinsurance Solutions. Andy, welcome.
Hi, nice to see you.
Good to see you. So we're here talking at the end of the Monte Carlo Rendezvous, so this gives you an opportunity to sum up some of the messages that you can take home to your colleagues.
So we came here with a fairly distinct message to the reinsurers on behalf of our clients, which was that the price of cat predominantly, there have been a lot of structural changes, the price have moved in a particular direction, and that the clients were looking for a more equitable sharing of risk given the volatility they had retained during 2024, and they were looking for flexibility in how to protect, sideways protection, how to drop down in certain perils to get a more, in their view and our view, a more equitable sharing of the risk and the profits. Not to say that the reinsurers, who I think in the main were receptive to that, knowing that the sort of core structures that had enabled them to return to profitability, post 22 and what had happened in the prior 5 years, that they actually, saw that the certain types of clients, particularly the regionals and the nationals globally, needed a bit more flexibility to navigate, the changing world that had been delivered to them by climate change and political instability.
So, and how receptive of your meetings been to that?
I think actually fairly receptive in the end because, fundamentally most of the reinsurers want to grow. Most of the clients, have a similar need, so they'll pick the partners that they want to help out. And, quickly the conversation went to U.S. casualty, which, mostly the rendezvous, is about international reinsurance, less about U.S., but the U.S. gets drawn in because it's a global reinsurance marketplace, and so the conversation went there and some of the needs that the reinsurers feel they have there. But mostly when we're talking about European and US regional property cat and Japan and Latin America, I think there's a willingness for the reinsurers to figure out solutions on behalf of the clients.
So it's interesting you say that because traditionally one gets the sense that some of the discussions here are driven by the preoccupations of North America. So we talk about hurricanes, we talk about US casualty, but of course it is a global industry. So what other considerations are we seeing from other parts of the world? You mentioned a couple there.
Well, sort of the talk track has been that the US regional accounts and national accounts, with their large positions on US casualty, have been squeezed both sides by reserve development and simultaneously taking an increasing share of the volatility from climate change and secondary perils, etc. But when you get to our European clients, and we have a big footprint at Aon in Europe and Asia and Latin America, they don't have the reserve development. And they're not that particularly interested in what that's doing to others. They're more interested in what the reinsurers are going to do for them. And, they've had, substantial changes in rates and structure. And, the regional and national clients, particularly in continental Europe, and it is wildly different from France versus Italy and Germany. But in the main, in order for them to return an adequate return on equity for their stakeholders, they need some more sideways protection. They need help in navigating, as I said, the complexity of the world. And I think the reinsurers, see an opportunity to increase up their participations and to help out. Now, that's not going to be the same for all customers, but I think largely the reinsurers will be helpful. We'll fight about the level of rate change and the level of need to drop down, whether they can do it on an RPP type basis or an individual peril basis, but those conversations are active and ongoing, and some of them already occurred and deals were done at Monte Carlo as they're supposed to be.
So you're Chief Executive of Aon Reinsurance Solutions, and that covers a broad range of things. There's been a sense over the past couple of years of traditional reinsurance and ILS working in partnership together, but as reinsurers have changed their risk appetites a bit, could we see that competition returning to those two areas, do you think?
Well, I think the ILS, and particularly the cat bond market, they're very attracted to the tail risk, and the reinsurers are very attracted to the tail risk. And so, that dynamic tension, if you will, is going to be evident in 25 as it was towards the end of 24, and that will present an opportunity for the reinsurers versus the ILS funds to differentiate themselves. I'm talking about the cat bond market, to be able to help their clients through the entire capital stack rather than in the tail. And the tail is important. The tail is where most people want to put their capital as reinsurers. They see the returns as more predictable, the products as more sustainable from a predictability standpoint, which is why the investors are more willing to enter that marketplace. Obviously, when you get down into the secondary peril arena, predictability is less certain, right? So there's a price for that, and the investors are less interested in terms of the cat bond market in that part of the equation. So that gives the UNL reinsurers, if you will, an advantage to participate through the whole program and maintain their share. So there will be a dynamic tension there, and we would encourage that. It's good for our clients.
Of course it is. So talking of investors, at this stage of the market cycle, one would expect perhaps to see new reinsurance companies starting up, and we haven't seen that to any great degree. Are there consequences of that?
Well, I think there's adequate capital, so we didn't have any issue placing really significant limits for Japanese and US clients and European clients. So usually new entrants come in when there's an imbalance of supply and demand. So they thought that would occur in 2022. It didn't really manifest itself. The other thing is that the investors, partly to what I referred to earlier, when they look at reinsurance modeling, they would say sometimes that it can be modeled, but the outcomes are not predicted for the models, right? So there was a lack of confidence from the investors in putting money onto reinsurance company balance sheets. Additionally, sort of returns in solely putting your capital onto a reinsurance balance sheet relative to an insurance company balance sheet, where the returns and the exits on those returns have been higher. So mostly capital is attracted to the insurance space versus the reinsurance space. Now, you do see, the returns for reinsurers being pretty attractive right now. A lot of that's driven by property, and naturally, the volatility, if you don't have the losses, you're going to get a higher return, and that is, attractive, but also you have to look at it over a 10-year period, not a 2-year period. So investors are sort of cautious, so that's why they're entering into the tail end of the cat programs via cat bonds and some collateralized reinsurance funds and sidecars.
Andy, thank you very much indeed for joining us.
You're welcome.
For Invest TV, I'm Richard Banks.